Most investors worry about volatility, but the real risk is the return you're locking in when you invest. That's why valuation matters. Hi, I'm Rasa Tefi, founder and senior wealth advisor at Yatra Wealth Design. And today I'm going to explain why valuation is one of the biggest determinants of long term returns, where we are in the valuation cycle today, and what that tells us about likely future returns over a longer period of time in the markets. So we're looking at this chart here. This is a chart of the S&P 500, and it's comparing the starting price to earnings ratio, which is one valuation metric, and on the bottom axis, and then on the left side, we have the future returns that have been realized from that starting valuation. And so you can see here by all these different dots that there's a very clear correlation or relationship here as all the dots go down and to the right, where if you start with a low starting valuation, a low price to earnings ratio, you end up with a higher 10-year return. And if you start with a high starting valuation, you end up with a low 10-year return. So just as an example, if there's a bunch of dots concentrated here around, let's say, 14 times price to earnings ratio, and that's kind of the median price to earnings ratio for the S&P 500. So there's a lot of examples of this, and basically what we've seen historically is that if you start investing with a 14 times price to earnings ratio, over the next 10 years, you've received somewhere in the range of, let's say, 6% a year return, and all the way up to, let's say, 15% a year returns over the next 10 years. So, that's a pretty big range. I mean, obviously some of those 10 years are a lot better than 10-year periods are a lot better than others. But it gives you a sense that if you start with, sort of normal earnings ratios of 14 times, you're going to get at least decent returns and sometimes really good returns, right? Whereas if you start with very low valuation or price to earnings ratio, you pretty much have always received really good returns over the next 10 years. And then where we are today, which is this gray bar down at about 23 times earnings, it's pretty high. And historically, if you started at 23 times earnings in the S&P 500, you've basically received somewhere between negative 2% and positive 2% per year for over a 10-year period. So that's where we are today. And I think, looking ahead based on history is a good idea. And so, this doesn't tell us that the market can't go higher. Obviously, we've had even higher valuations in the past. But realistically, anytime you're at 23 times or above, you have to anticipate that it's very likely that you could get low or even negative returns over a longer period of time. Now this is the S&P 500 cyclically adjusted price to earnings ratio. This is basically smoothing out the earnings of the S&P 500 over a 10-year period and adjusting them with inflation. And then it says, okay, how many times that are we paying today? And the nice thing about this valuation metric is we have data going all the way back to 1920, so we can compare where we are today to history. And you can see that where we are today at about 38 times the CAPE ratio is actually the second highest it's ever been in the last 100 plus years. The only time it was higher than today was in the late 90s, early 2000s tech bubble. So obviously, valuations are pretty high today, and the question is, what does that tell us about, future potential returns? Well, again, we have to look at history to get a sense of that. And historically speaking, if you start investing with the CAPE ratio at 35 times or above, over any meaningful time frame, you've gotten negative returns. So over a 3-year period, negative returns, 5-year and 10-year. Now again, that's not guaranteed or anything like that, but today at 38 times the CAPE ratio, that's pretty high historically speaking, and it's something to be at least aware of and potentially concerned about. Now this last chart, this tells us and demonstrates that valuations don't really explain what the market's going to do in a shorter period of time. I mean, they really don't tell you how much of anything about, let's say, what the markets are going to do over the next 6 months or year, or even a little bit longer than that. But what this chart demonstrates is that as you go further and further out in time, a bigger and bigger percentage of your returns are explained by your starting valuations. And so basically, over let's say a 12 to 14 year period, almost 80% of your returns are explained by what your starting valuation was. So if you start with a very high valuation like we have today, it's very likely mathematically that you'll receive a low return. Um, but it doesn't tell you that you're going to get a low return over the next 6 months or 1 year. I mean, the markets can continue going higher and go to even higher valuations as we've seen. So, as investors, and what we do for our clients is we're aware of these valuation metrics, and we take a look at things and say, like we are today, if things are kind of extreme and there's certain markets where the expected returns are not very good over a longer period of time, we may want to make an adjustment and diversify into other areas of the investing universe that have higher and better potential return outcomes over a longer period of time. Because while this doesn't tell us what's going to happen in the next 6 months, we like to have the wind at our backs, and we like to hold more of the investments that are very likely to have strong returns over a longer period of time, because we are longer term investors. And if things ever get extreme like they are today, either very highly valued or very low valued, we want to take that into consideration as we make investment decisions. So please let me know if you have any questions. Happy to discuss it with you, and have a great day.